Hello, I'm Justin Bergen, Vice President of Equity Research at Ameriprise Financial. Welcome to this episode of Ameriprise Talks, where our quarterly panel of experts share perspectives on the markets and economy. To briefly recap, the third quarter of 2025 has largely been a positive one for investors. The stock market has reached all-time highs, the Federal Reserve has cut rates, and overall consumer and investor sentiment is positive. However, uncertainties persist. Inflation continues to be elevated, the labor market is softening, and tariffs remain a risk to the broader environment. To help you make sense of what could be in store for the final months of 2025, I would like to introduce Anthony Saglin-Benny, Chief Market Strategist of Ameriprise, and Brian Erickson, Fixed Income Strategist at Ameriprise. Thank you all for joining me. Anthony, I'd like to start with you. The U.S. economy continues to show incredible resilience, and stocks reached new highs in the third quarter thanks to AI optimism and the strong corporate earnings. What's contributing to this positive momentum in the economy and stocks? And what macroeconomic indicators are you watching as we close out the year?
You're right, Justin. The U.S. economy and stocks performed very well in the third quarter. The S&P 500 finished the third quarter up nearly 8%, and we estimate the U.S. economy grew by a solid 2.8% in the July through September period. This broad-based strength was driven by strong corporate earnings, stable macroeconomic conditions, AI tailwinds, and the Federal Reserve's first rate cut since December. From an economic perspective, consumer and business conditions remain constructive, and the impacts of tariffs appear manageable thus far. The unemployment rate has held mostly steady, weekly jobless claims have improved from midsummer levels, and consumer spending and income levels remain on firm footing, even as job creation has softened and inflation has stayed elevated, which could complicate the Fed's policy path moving forward, as Brian will discuss. Looking ahead, further stock gains will likely depend on companies meeting elevated profit expectations at the start of the fourth quarter. In particular, big tech companies may need to deliver more concrete details on their AI spending and monetization strategies to help justify elevated valuations. In addition, key macro indicators we'll be watching as we close out the year include developments on the labor market, inflation, consumer spending, and the pace of future rate cuts. And trade policy and tariffs remain wildcards for the market, with the Supreme Court's upcoming decision on the White House's reciprocal tariffs potentially impacting trade sentiment heading into 2026. Notably, positive seasonality factors tend to favor continued stock momentum in the fourth quarter. Historically, when the S&P 500 is higher year-to-date through the third quarter, the fourth quarter has averaged a positive return 83% of the time, going back to 1928. However, with valuation stretched, a disciplined investment approach is important. We recommend investors maintain a diversified portfolio focused on high-quality assets and companies with durable businesses and visible profit trends. Bottom line, we're maintaining our guarded yet positive outlook for the economy and stocks through year-end. But investors should remain vigilant in monitoring their portfolios, reach out to their advisors with questions and concerns, and use potential volatility in Q4 should it arise as an opportunity to add high-quality holdings which your advisor is well-equipped to assist with. So Justin, speaking of interest rate cuts, can you shed some light on which sectors and industries may most significantly be impacted by a drop in rates? Where might there be new equity opportunities for investors?
Yeah, certainly, Anthony. When we talk about interest rate cuts, the classic advice remains, don't fight the Fed. It's a simple message, but investors often make it harder than it needs to be. Historically, shifts in monetary policy, like a move to lower rates, represent a fundamental change in the cost of capital for businesses. Lower interest rates make borrowing more affordable, which has a ripple effect throughout the economy, affecting various sectors and industries differently. Traditionally, some of the beneficiaries of declining rates are income-oriented sectors, such as utilities and real estate investment trusts. Utilities, in particular, stand out to us because they combine their typical high dividend yields with growth opportunities tied to evolving demand. Think of the surge in power needs from expanding data centers used to power AI models. With yields on money market funds and other safe assets falling, investors seeking income may find renewed opportunities in these areas. Beyond sector-specific plays, lower rates tend to create a favorable operating environment for small-cap companies. These firms often carry large proportions of floating rate debt versus their large-cap counterparts. When rates drop, their interest expenses decrease, directly improving margins and profitability. This effect is even more pronounced when rate cuts are implemented from a position of economic strength, which is where we sit today, rather than as a reaction to recessionary fears. In such scenarios, the potential for earnings growth among small caps can be beneficial, offering intriguing equity opportunities for aggressive investors willing to explore this segment. Finally, it's worth noting that the positive impact that companies are linked to capital markets activities within the financials can have. Lower rates often spur increased IPO activity, mergers and acquisitions, debt refinancing, and new debt issuance, all of which are beneficial for capital markets firms. This scenario was a theme we highlighted in our 2025 equity outlook at the beginning of the year, and it continues to play out as we head into 2026. With that, I'd like to get Brian's perspective on fixed income. Brian, let's continue on the theme of interest rate cuts. How might this recent move by the Fed impact the bond and treasury markets?
Thanks, Justin. We believe the Fed likely continues to lower its policy rate into 2026 as labor markets transition along with global trade and immigration dynamics, AI, and aging population. Cash investment yields typically track closely to the Fed's policy rate. This suggests that investors holding excess liquidity should consider moving into fixed income to retain more attractive yields for a longer period. When the Fed lowers its policy rate, fixed income typically benefits. Declining yields drive price appreciation, enhancing returns alongside coupon income. Although the Federal Reserve is easing short-term borrowing costs, persistent deficit spending and the ongoing refinancing of approximately $37 trillion in outstanding U.S. Treasury debt may exert upward pressure on long-duration yields, including the 30-year. Since rising yields correspond to declining prices, we view this dynamic as a potential tactical opportunity, akin to buying equities into a dip, particularly if elevated yields prove transitory. Today, I have 5 takeaways for fixed income investors. First, reevaluate the role of floating rate positions in existing portfolios. The onset of further rate cuts suggests softer returns may be ahead. Second, investors may want to consider diversifying high-quality fixed income. Treasuries have become 45% of the U.S. aggregate bond index. We look at securitized debt, investment-grade corporates, developed foreign debt, and even U.S. municipals where appropriate. Actively managed strategies typically manage this risk for investors. Third, this quarter, we tactically underweighted treasuries, especially avoiding long-term treasuries where we could see selling if the economy slows and investors grow concerned about the level of federal debt. Fourth, we tactically overweighted U.S. investment-grade corporates due to continued record earnings and cash flow from that sector, and the support of fiscal and monetary policy as well. We also see opportunities in the municipal space. The 3+% return in the third quarter still leaves solid taxable equivalent yields on the long end of the curve there.
Really insightful information and perspective. Some great takeaways for investors. With that, thank you to my colleagues, Anthony and Brian, for joining this conversation. And thank you to our clients and other viewers for watching. If you have questions about current market conditions or would like to receive additional timely insights from the Ameriprise Investment Research Group, please contact your Ameriprise Financial Advisor. Thank you.